Hi everybody, in this example we are going to calculate cost of goods sold and cost of goods manufactured, and we'll take a look at it from a different perspective. In the example we are given the sales revenue, the gross margin, the operating income, the inventory levels beginning and ending for finished goods and work in process, and we are given the direct materials used, direct labor used, and factory overhead. Now, we are kind of going to go backwards. In the previous examples, we first calculated cost of goods manufactured, and then we calculated cost of goods sold. In this case, we are going to first calculate cost of goods sold, the first question mark right here, and then calculate cost of goods manufactured. So why don't we start? In order to calculate cost of goods sold, we know the gross margin, and gross margin is equal to sales revenue minus cost of goods sold. That's the definition. So I know both gross margin and sales revenue, then I can calculate cost of goods sold. If you look at the entire income statement, it's sales revenue minus cost of goods sold is gross margin, minus sales general and administrative is going to give us operating income, minus tax is income after tax. Now, focusing on the top part, we are going to see that sales revenue minus cost of goods sold is gross margin. So cost of goods sold, if I solve for this, needs to be $35,000 for gross margin to be $25,000 when sales revenue is $60,000. Now, I do know cost of goods sold. Let's calculate selling general and administrative. I know that gross margin minus SG&A, selling general and administrative expense, is going to be equal to operating income. So in that case, it is gross margin minus SG&A is operating income. 25,000 minus SG&A is 15,000. So I can calculate SG&A as well. I solve this equation, 25,000 minus SG&A is equal to 15,000. SG&A turns out to be 10,000 in this case. Now, let's take a look at cost of goods manufactured. For that, what we need to know is the beginning and ending finished goods inventory. And I'm going to apply the same equation over and over again. Beginning inventory plus transfers in is equal to ending inventory plus transfers out. So if I apply that to finished goods inventory, it's going to be finished goods inventory beginning plus transfers in, which is cost of goods manufactured, is equal to ending inventory plus transfers out, cost of goods sold. Now, why is transfers in cost of goods manufactured? Because of the flow I've shown you in previous examples. Working process inventory, the credit is cost of goods manufactured. It transfers out from working process inventory. It goes straight into finished goods inventory. Now, I know the beginning balance of finished goods. I know the ending balance of finished goods. I also know cost of goods sold. Then I can calculate cost of goods manufactured. Beginning balance 10,000 plus transfers in, cost of goods manufactured coming from here to here, is equal to ending inventory plus cost of goods sold, transfers out to the customer. If I solve this equation, the cost of goods manufactured turns out to be $75,000. It's basically 50,000 plus 35,000 minus the 10,000 we have here. Now, the other part is to calculate the total manufacturing cost. Total manufacturing cost, by definition, is the sum of direct materials used, direct labor used, and factory overhead. So it's literally that sum with $100,000, zero missing here, $100,000, it's 50,000 plus 20,000 plus 30,000, nothing more. Now, there is also a question mark on the working process ending inventory, so we need to calculate that. Now, I do know the beginning balance. I do know the transfers in, which is direct material, direct labor, and overhead. I do know transfers out, so I know beginning inventory, I know transfers in, direct material, direct labor, and factory overhead. I know transfers out. I can calculate ending inventory right here. So the beginning balance was 5,000. We are adding 100,000. That 100,000 is again total manufacturing cost, which is the sum of these three: direct material, direct labor, and factory overhead. That is equal to ending inventory plus 75,000. Where does 75,000 come from? That's the one I calculated in the previous example. If I go back here, I calculated 75,000 as cost of goods manufactured. So hence, I do know 75,000 from the previous problem. Now I can calculate working process ending inventory by solving this equation right here. And it's going to give me working inventory ending is equal to 5,000 plus 100,000 minus the 75,000. I take the 75,000 back to this side of the equation, and working process ending inventory turns out to be $30,000. With that, we have solved cost of goods manufactured, cost of goods sold, and different variables that are unknown, like ending working process inventory or SG&A, from a different perspective. We kind of looked at it from backwards, from end to the beginning. Usually the flow goes from working process inventory to finished goods and then to cost of goods sold, which is what we solved in problems 2 and 3. And now we did it in another direction with a different perspective.